how that's verified in a minute or a few minutes. Well, they could have good personal credit, or they could have some kind of collateral. You have to have one to get a loan or a credit line. Now, of course, if you have none, well, that's where business credit comes in and saves the day, right? Because business credit is something any business owner can get. So it's a way to be able to still earn a profit and help a customer when you typically can't through financing. But when it comes to loans and credit lines, when it comes to business funding, when it comes to business financing, it really all comes down to having one of these three C's: cash flow, credit, collateral. The more of the C's you have, the more loan options open up. Meaning, if you have two of the C's, like good credit and cash flow, that opens up term loans and lines of credit and better, longer rate, lower term financing. And of course, if you have the trifecta, cash flow, credit, and collateral, then you're getting an SBA loan. And we'll talk a little bit more about SBA loans today as well. So the goal for any borrower is to be able to help work with them to get as much of this as possible. You know, our goal is that we get the financing, for example, as they're a startup based on credit, then that gets them the money to start generating cash flow. Then we educate them and teach them about assets like account receivable, collateral, and then they have the trifecta. We graduate them from step to an SBA loan, which is the ultimate goal. So in this training today, we're going to be talking about cash flow, and we're going to be talking about the credit and collateral components of qualification and all the financing that entails in some later training over the next couple of weeks. So cash flow financing. Well, approval is based on cash flow coming into the business. This could be called a lot of different things. Revenue lending, cash flow financing. I call this revenue cash advances, because that's basically what it is. It's cash advances like we're used to with places like AMSCA, but it's basically done on the business's revenue. So approval is based on the cash flow, the revenue coming into the business, and it's basically based on responsible bank management. That's what's key here. So they're looking at consistent deposits. They don't want to see a real estate agent with a deposit here or there. They're looking for a bunch of deposits in a month. So for example, a retail company, or even us, for example, we process transactions every day. So, we get a merchant deposit every single day. That's what they're looking for. They're looking for a lot of deposits. So if some of those didn't take place the next month, you're still going to have that money going to the bank account. They're looking for positive cash flow, more money going in the bank account than going out of the bank account. They're looking for low to no non-sufficient funds, NSFs. These are horrible. These are deal killers. And the reason these are deal killers is because what happens is banks are primarily, look, the number one concern of any lender is if the borrower can pay back the debt. Never forget that. It's always the primary concern. All the requests for documentation, every question they ask, it all goes back to one thing. Can this borrower afford this? Well, if somebody has non-sufficient funds, they're overdrawing their account now, then a lender says, well, how could you make a loan payment when you can't even afford your current expenses? So again, they're looking for low to non-sufficient funds. They don't want to see that borrower is overdrawing that account, and they're looking for positive ending bank balances. So they want to see that at the end of every month that there's money left over, because again, how would you pay a loan back if there is no money left over? Now, I did a live stream on Facebook, facebook.com/credit suite, that goes much more into this, that really breaks down all of the aspects of what lenders are looking for on the bank statements, but that's a primary look at what they're looking for. Now, some financing looks at tax returns. So they're going to want to see that you have 1 to 3 years worth of tax returns. SBA loans will want 3, and if you're looking at a lot of alternative lenders that do term loans, they'll want 1 year. They're going to look for increasing revenues and profits. They want to see on the tax returns that revenues increase from year to year. They want to see the profits increase from year to year. And they also want to see that you're earning a profit, not a loss. This is one of the biggest mistakes that I see business owners make outside of using their personal credit to try to grow their business, which is that they write off everything and claim a loss on their tax returns so they don't have to pay taxes. The difference in our world of helping borrowers obtain financing is night and day between somebody that shows a little profit and somebody that shows a little loss. A business is either profitable or they're not. And responsible businesses get to a point where they can't really hide the profits. You have to start showing the profits because there is so much profit. This is what lenders are looking for. They're looking to lend to people that are showing a profit because really there's no way you could hide that you're making money. And that is kind of the transition between, a small business that's kind of trying to write off everything and pay out as little in taxes as possible, and a business that's growing, that's showing profit, knowing they're going to have to pay taxes on it. Now, I start with this slide, but the reality is they're not looking for all of this. Some are looking at tax returns. Some are looking at bank statements. I'm going to go through a bunch of financing options and tell you which one they are. But when I tell you that it's based on responsible bank management, or basically based on a review of bank statements, I want you to know what they're looking for. If I tell you that they're going to want tax returns, I want you to know what they're looking for. Because by knowing what they're looking for, no matter what kind of loans we're doing, if we understand what the lenders and credit issuers look for, then it's easier for us to help the borrower only apply when they know they can qualify, and help prevent them from getting unnecessary denial. So here's what they're looking for when they're asking for tax returns and bank accounts. Not to say they're going to ask for both. We'll talk about which ones they may be asking for. So revenue cash advances and merchant advances. I kind of put these all into the same category when I often talk about them, and I oftentimes refer to them as revenue cash advances, although there are probably over 20 confirmed names for this kind of financing. So this is super fast money, can be secured in about 3 to 7 days. We've got it in as little as 24 hours. It's easy money, no credit score or collateral requirements in most cases. Some lenders will pull credit, some will not. The ones that do go about as low as a 500 FICO. So this is a very forgiving type of financing for somebody that has credit issues. All that's needed for approval is a 6 months bank statement or merchant account statement for review. They're typically going to want both. They're basically going to want 6 months worth of bank statements, and they're going to want 6 months worth of merchant statements. What's the difference? Bank statements obviously shows all the activity going through your bank account, and merchant statements show all the activity that you're processing through credit cards. So they're typically going to want both, and supplying both will always give a borrower the best chance of getting approved. And again, they're looking for stability. I already explained what they're looking for in those bank statements. Loan amounts are pretty equal to about 12% of annual revenue. This fluctuates based on risk. They may give them a little more, they may give them a little less, but we found that on average, approvals are about 12% of the annual revenue. So if the annual revenue is $200,000, 12% is obviously 24 grand. That's a little bit, maybe right in the middle, a little below or a little above what you may typically see them offer on a first position loan. We'll talk about second position loans soon as well. Typically, these loans have daily paybacks. That's why people do not like them, meaning the lenders withdraw money daily from the business owner's bank account, from the business's bank account. Okay, but on lower risk deals, then we can also do weekly or even monthly paybacks. So if you have a lower risk borrower, then it's very available for them to get weekly and monthly paybacks. Some lenders will offer it, other lenders won't. But the bottom line is, if you have a lower risk borrower, better credit, better bank account management, longer time in business, any of those kind of factors can mean a better borrower, then you're typically going to have somebody that can pay a payment just like a regular loan, once a week, once every 2 weeks, once a month for the loan, instead of having money withdrawn from their bank account daily. It's still usually withdrawn automatically. It's just done almost, I will say it always is. I've never seen a case where it isn't, but it could just be done weekly, bi-weekly, or monthly to make it more convenient for the actual borrower. Now, these are short-term loans, typically on average 6 to 18 months. Okay, you can go up to 36 months. That's the highest I've ever seen them. Not to say that it's the highest they'll go, but that's the highest that we've typically seen. And usually when somebody gets their very first of these kind of advances, they're usually going to get 3 to 9 month term. So the way this usually goes, the term is much shorter on the first advance. Once the person proves themselves, they start getting longer and longer terms the more advances they get. And 9 to 18 months available for lower risk, or the second advances, the second time somebody gets the loan. Again, lower risk scenarios means somebody could usually push the payments out longer, okay? So we look at these. We've actually had one of these revenue advances, and it helped us greatly. We got the money to open a new office, to make some hires and do some marketing, and that all produced great growth for the company. So we've looked at these again, and when we look, we're quoted 36 months. So we're quoted the longer term, partially because we paid one back as agreed, and partially because our risk is just lower. Time in business is longer, bank account management is good, etc. So these sometimes get a bad rap because people think it's really expensive money, but I can tell you that's absolutely not true. We see rates of 8 to 15%, which are pretty equivalent to what you may see with SBA or alternative SBA loans on lower risk borrowers. But when you have higher risk borrowers, shorter term in business, shorter time in business, damaged credit, bad bank account management, that's what really drives the rates up, up, up. which to me is a good sign. This is a loan that can work with people that are challenge credit, that are higher risk. But then again, of course, with any kind of lending, they're going to end up paying through rate for that risk. So loan amounts up to $500,000 typically. Some sources are less. This is about the most I've ever seen on revenue lending. Not to say there's some lenders that are higher, but almost everyone you'll see will not exceed a cap of $500,000 loan amount. Over 70% of our clients come back and get more money. That ranges from 70 to 80%. So I'm being extremely conservative. Why you should care is because that's where you make your money. They get the first loan. It's so much easier to get the second, third, fourth advance down the road. If you do this right, then what will happen is 70% will come back and get more money again and again and again and again. Okay, so then that means that you continue to earn money every time they fund, but it also means that the customer has a super easy way to get money whenever they need it. Usually 1 month's bank statement is all that's supplied, and a quick review means that money could be in somebody's bank account in 24 hours. I told you earlier that we funded one of these in 24 hours. That's exactly what happened. We'd already done the first advance for him. They came in, they needed to meet payroll. They realized the day before they couldn't meet payroll. So then they came in and we got them the advance so they could then meet payroll. So very simple to get more money when they come back for a second advance. Rates 65%. I don't know. That sounds good. I've seen rates a little lower. I've never seen rates higher. I personally like any kind of financing that has a really wide range of interest rates, because what that means to me is it means it's a good financing option for somebody that's lower risk, but it's also a good financing or can work as a financing option for somebody that's extremely high risk. So this is a financing vehicle that, again, it works really well for people with low risk or high risk. So you have a lot of flexibility with this program. Now, what affects risk? Time in business, the industry somebody's in, their personal credit quality, their bank account management, the ending balances. Those are just some and probably the main factors that are going to affect business risk or affect risk and rate. Fees and interest are 100% tax deductible. Great selling point when you're speaking to anybody about this, that they're able to come in and write off all the interest and the fees. Basically, they get the fees back as they write off. So affordability is what matters most. Look, here's how these work. Typically, a lender will give you 3 to 4 to 5 different options. So our finance officers, for example, they're given an approval with 3 to 5 different options. The options usually have shorter terms and lower rates. So you can get a lower rate if you are willing to pay it over a shorter term. If you win a longer term, you will pay a higher rate. Why does this matter? Because here is one of the biggest misconceptions in 18 years of working in the finance industry I've seen on both consumer and commercial. Everybody cares about rate when they shouldn't. Rate is really based on risk. The difference between somebody getting 10 and 65% is the risk that that borrower is. Okay, if you don't like the rate, then control your risk, fix your credit, manage your bank account responsibly, more responsibly, et cetera, et cetera, et cetera. But what matters most to payment, and that's really what people really care about most is payment, is term. Term matters more to payment than rate. And we see this with this kind of financing all the time. When people are given a choice, 95% of the time, they go with the longer term and higher rate because that gives them the lower payment. So you need to know some of this language and say, hey, look, the rate's tax deductible. Who cares about that? We're really concerned about payment. As you'll see here, this option gives a longer payment term. Now, again, if you're trying to work with the customer yourself, then these are the type of things that are very difficult to explain. And this is what's awesome about our finance team is that having finance officers that do this hundreds and hundreds and hundreds of times, they're very good at explaining the kind of approvals and options that somebody has, so then they can decide what works best for them as a borrower. So can't be currently in trouble such as a bankruptcy or very recent liens. You've got to have about $120,000 in annual revenue to qualify. That's 10 grand a month. Now, there are ways you can get down to getting approved with about 5 grand a month, and these are called compensating factors. That term is used both in the consumer and commercial world, and this has to do with other factors that maybe lower your risk. Maybe you don't have the revenue, but great time in business or great bank account management or great credit. Those type of things can maybe help you get approved if your revenue is a little less than 10. But standard of what you're going to find with most lenders is 10. Some will go down to 5. Compensating factors will help you get there. 12 months in business. With compensating factors, they can go down to about 6 months. Same thing. You know, you have better credit, you have more revenue, you have good bank account management. That can make it where you might not need the full 12 months if you have other compensating factors. They're going to want to see more than 6 deposits monthly. This fluctuates between bank and bank to bank, less than 10 non-sufficient funds, positive balance at the end of each month. And these are some of the factors. But look, what it really comes down to is that they want to see they want to see consistent deposits. They want to see good bank account management. They want to see you have the money left in the account to pay. That's what they're looking for. The number of deposits, the number of NSFs, this is wildly going to vary lender by lender. It really is. So again, what matters most is, are they managing the bank account responsibly? And when it comes to payouts, this could be one of the most lucrative products that pays you as somebody that earns fees on financing, that pays you well. Okay, so as a partner, you earn good money on these. But the problem is that there's so much money to be made with these that a lot of people are overcharging. Hundreds, if not thousands, of banks and lenders trying to offer this product are popping up everywhere. If this is the sole product that you're offering because it pays well, you're going to have problems, because these things are a dime a dozen. Everybody offers this kind of financing. So just something to be aware of. Okay, so some lenders now offer credit lines with this product. Okay, these lines are usually for about 20 grand and are in the addition to the loan that they'll get. So you'll start to find this is common. Why is this happening? Because second position lenders came up. Lenders came up and said, hey, look, if you know you're going to get a first loan with whoever it may be, lender, then we're willing to offer you a second loan right behind it. Well, a lot of lenders aren't liking this, so what they're now doing is offering credit lines. So they're offering their own second position loan behind their own first position loan. And it's typically a credit line, but they're usually going to want to see better credit for that, about a 680 FICO. Lenders often want to see tax returns for that to work as well. And the revenue looks at all of the deposits when we're talking about revenue lending. Something else to mention, we're looking at, when we talk about revenue cash advances, we're looking at all revenue. We're looking at Visa card deposit, Amex deposits, check. We're looking at cash. We're looking at everything. That's going to be a little different than merchant advances, which we're about to dive into right now. So merchant cash advances, also popularly known as MCAs, work much the same as the revenue cash advances, but for an MCA, only credit card deposits are used, not cash or checks. It's one of the main differences between a merchant cash advance is that merchant cash advances are basically looking at merchant transactions, which are typically Visa or MasterCard deposits. Now, American Express is typically treated differently, and American Express will, if you're processing with American Express, you can also get a revenue cash advance or merchant cash advance with Amex. They'll start sending you notices too. So typically a merchant cash advance will not look at American Express deposits. They won't take that into your total. So if you want to use American Express deposits to be able to borrow money against, Amex themselves will offer a merchant cash advance for you to do so, but it's not typically involved in a normal MCA loan. And PayPal and Square will lend based on deposits into their accounts as well. So I really like these. Look, as loan brokers, these don't pay. These won't pay you money as partners. These aren't going to pay money, but it doesn't matter. What I've always believed is that you really need to keep your focus on doing the best thing for the customer and advising them the best way, whether it puts money in your pocket or not. If you always focus on doing what's right for the customer, the money will follow. You have to go and believe, you have to have that belief. Otherwise, the minute you start not doing right by the customer to line your pockets, things really become problematic. So with PayPal and Square, you're not going to make money, but somebody could typically get about 30% of the amount of their deposits from a PayPal or Square loan. Okay, and I'm not saying they won't pay. Maybe eventually they will pay brokers money, but that's really not what's going on right now. So typically, as I mentioned, a merchant cash advance or revenue cash advance is only going to be about 12% of revenue. But with these, PayPal and Square oftentimes will go as much as 30% of the deposits, and PayPal will go about as high as 120,000 last time I checked, and all these numbers change from day to day and week to week. And it's pretty flat and cheap fees with them as well. So we always advise clients, hey, look, if you're starting a business especially, get a PayPal account or get a Square account and have some of your transactions going through PayPal or Square, because it's going to open up funding options for you fairly quickly, about 6 months into business. So again, these are really good options for borrowers. Even though brokers don't make money on them, these are really good options for borrowers because they can typically get almost a triple the amount of financing based on PayPal or Square deposits. But of course, it's only going to be based on PayPal or Square deposits. So, if you're putting 90,000 a month into your business bank account, and then 10,000 goes through PayPal, well, you're only ever going to be able to borrow the money with PayPal from that 10,000 that goes through PayPal. So something to keep in mind. Now, the industry restrictions do apply. So again, based on certain industries, you might be higher risk. Which industries? A lot of the common ones: ammunition, porn, financial services, But a lot of lenders have their own restrictions based on industry, based on individual performance. So I find that, a lender will completely write off an industry and won't touch it. And when we ask them why, it's because they had one big loan default for that industry, or they have some kind of track history of defaulting for that industry. So industry restrictions are industry wide and sometimes lender specific as well. Loans are based on bank accounts, and by that I mean the industry that the borrower's in. Loans are based on bank accounts, not total business revenue if operating more than one business bank account. A lot of people do this. A lot of people have multiple bank accounts, and then they want to tally up the deposits with all those bank accounts. It won't work like that. The lenders are going to primarily look at one bank account and make the decision of lending based on that. So if you have multiple bank accounts, that's okay. We do too. We have like a money market account. We have a savings account, a checking account. All money goes through checking, and then all money gets distributed to the other two. The money market's the profit account. The savings account is savings for overflow. And then your checking account is where all of the activity takes place. So if we're ever trying to do any kind of transaction, all of our activity goes through one account, and then money is housed in the other accounts. So no prepayment penalties, because remember, we're looking and making loan decisions here based on deposits, based on revenue into the bank account. So if the revenue goes into the bank account and then it gets taken out and put into a money market account, then the bank statements reflect that, and that's okay because they're looking at total deposits, not total money you're holding in that account. So it's okay to have multiple accounts. You just want to have one account all the activity happens with, and then from there you can move money into savings and money market, et cetera, and still get credit for all those deposits. So there's no prepayment penalties in most cases. So if somebody pays it off early, in a lot of cases they're not going to have to pay the interest. Very lender specific, will change. First and second loan positions available. I mentioned that. There's a lot of lenders now that will go and do second position behind the first. So if we get a first position MCA, then they'll come behind and do a second position on revenue cash advances, merchant cash advances, approvals in 24 hours with one-page application and 6 months bank statements. Typically, even sometimes approval happens same day when those are supplied. And as I mentioned, can fund as little as 72 hours. Look, funding time is always based on borrower's time. Borrowers are either going to work with you and get you what you need quickly, or they're not. And when they delay, that delays the time for it and then the clearing fund. If you have somebody that comes in and says, I want a revenue cash advance, or this is what I want, here's my bank statements, and then you get an approval tomorrow and you call them and they answer the phone and say, okay, I want that approval. And you say, okay, and we say to them, you need a license and these other things, and they supply those other things, then what happens is the loan closes very quick. It can happen in 3 days. Usually delays are caused by the borrower not getting on the phone or not getting documents that they need to get, and money is used to expand a business, not for slow time. So anytime on a slide I ever put something in bold, red, that's about as extreme as I can get to prove a point. Money should not be used for seasonal businesses and slow times. Look, this is not the cheapest money. If somebody is investing it into growth of the business, then it makes a lot of sense. But if they're investing it to get through slow times, it's just not really going to work for that purpose. It's just not. So I have a friend of mine that was actually a teacher of mine in high school. Him and I were really close then, or really close now. I saw him post something on Facebook saying he needed money. I thought, I haven't talked to him in a while. I responded. Him and I got on a call, catch up. And he said, look, here's the deal. I'm going into the slow time of year. And he explained it. He needed money. I said, look, based on everything you said, this would be the only option that would work. It will not work for you, and I do not recommend it, because this is not money you get to get yourself through a slow time. It's money you get to reinvest in the business for growth. We wrapped up our call. Days later, I saw him put a scathing post on Facebook that he talked to somebody else and the other person offered him this loan. And he was so angry because the rate and the payment were so high that he knew he couldn't afford it. And he said, this is highway robbery. That's a typical example of what happens. If somebody is taking the money and investing it to grow their business, this kind of financing makes a lot of sense. If somebody's trying to get the money to get through slow time, it will not make sense for them. So be responsible with this kind of financing. This is not something we would ever offer to a customer if they say they're trying to get through a slow time, because that won't work for them. It won't solve their immediate problem. They need access to probably revolving credit. Credit cards or credit lines they can pay small minimum payments, low interest rates on till they get through the slower time. That's not usually the best position to get loans, especially higher risk, higher rate type of loans. So can it help a business grow? We had a client that used it and had outrageous interest rate. It was like 45% plus, but they used it because they are a software or soft drink company and they needed to bring their manufacturing in-house. They were like, I think all the packaging of the putting all the stuff into the cans was done outside. And when they brought it in, no matter how much they paid on the loan, they made like $30,000 a month more in profits. It was a no-brainer. So those kind of financing where somebody's investing into growth make a lot of sense. We had a truck driver that had one truck on the road and she wanted like 40 grand. We got her 8 grand for a beat up old truck. She got another truck. She doubled her trucks and then she doubled her revenue. She had 2 trucks on the road. She came back and 3 months later, her revenue had doubled and we got her another like 40 grand. I mean, we ended up getting her hundreds of thousands of dollars because she's investing the money to put more trucks on the road. And as she puts more trucks on the road, the business grows. That's investing for growth. I mentioned that when we got this, we invested on marketing. So again, when you're investing in strategies that will grow the business, especially if they're proven, that's the best use of this money. It's not to get yourself through slow times. So be careful when you're talking to borrowers about this. So additional details, approval in 24 hours. We talked about that. And I think we've already talked about that. Okay, so revenue-based credit line. So approvals are now based on revenue review of the bank account through artificial intelligence. So this is new. Few lenders are doing this, but my personal favorite credit line in 2018, they're looking for the same thing we always see. Good bank account management, basically. I already went over all that. Typical lines are under 10 grand. That's typically what will happen. You'll typically get an approval with no credit check for $3,000 to $6,000, super low rate, less than 5%. Then if you're willing to supply tax returns or sometimes a credit check, then they'll give you higher approvals, typically 20, 30,000 or higher. And if you show tax returns that you have revenue over 300, then we typically see that they'll go as high as a $100,000 credit line. And again, with tax returns and a credit check, you have a better chance of getting approved for the higher amounts. So rates are about 0.5 to 0.7% per week outstanding. I love this. It's one of my favorite kind of funding, and here's why. Because it's super cheap, easy money. I mean, you can get it without a credit check with good bank account management, and you can get it with super low rates. I mean, if you kept this money outstanding for 6 months, it would be like less than 5%, like 4.875%. But if you only keep the money outstanding for 2 weeks, well, then you might only pay 1%, 1.5% interest on that. So $50 per every 1,000 borrowed to give you an idea what that means on money term. Payback terms of 12 to 24 weeks. You can go up to about 6 months. Can't have BK. Pretty quick funding. High-risk industries are accepted. No prepayment penalties on this kind of money. So I want to talk to you a little bit more about this. And you can go to creditsuite.com/fundbox to learn more. Fundbox, Fundbox. So the way that this program works is this, and I'll give you an example. A friend of mine came to me and said, I want a merchant cash advance. And I said, okay, why do you want the money? What are you using it for? And he explained it. And I said, okay, I asked him some other questions. I said, look, you don't need a merchant cash advance. This is going to be too expensive for you. I want you to go and let's see if we can get you proof for this. We got him approved for $6,000. He was willing to supply tax returns. He did. There wasn't a credit check at that point. And he got approved for $30,000 on a credit line. He used the money for what he said he was going to use it for and paid it back exactly the term he told me he was going to pay it back. He paid less than 1% interest, and he has a $30,000 credit line he could use and reuse at will. He loved it. He could not tell you how happy he was because he was willing to pay 15, 20% interest on something he paid a fraction of that on, and he got a credit line out of it he could reuse and use again. So this is something to keep in mind. It's easy and even easy to get approved with higher risk industries versus regular cash advances. So love this product because it's fairly easy to get approved for. The other thing I want to bring up here is artificial intelligence is changing the way that financing works in our industry. What artificial intelligence is doing, think about Rocket Mortgage. They're now going out electronically and getting your data and pulling it in so you don't need documents. So with this program, they electronically plug into your bank account. Then what they do is they determine your bank account management through their computer algorithm, however it does what it does, and you never need to supply bank statements. So because you don't need to supply bank statements and because the computer can immediately underwrite, it's fast. It's really fast funding. So you're able to actually come in here and get the money fairly quick. I mean, get a credit line in 2 days, which used to be unheard of because these computers are making these decisions so quick because they're able to get the documents electronically. So some things changing here. You need to know that because artificial intelligence, blockchain, this kind of stuff is going to disrupt and change our industry when it comes to commercial financing. So you need to see how it already is, and artificial intelligence is a perfect example here. Another program gives you about 0.3%, this is through Bluevine, 0.3% to 1.5% per week outstanding, but this one goes up to 12 months, and the other one went up to 100 grand. This one goes up to 150 grand. Weekly and monthly payments are available. No prepayment penalties, 72-hour funding. High-risk industries are accepted. 620 plus FICO. They do pull credit. They do want to see a 620 plus FICO score to get approved. 20,000 monthly deposits. The other one that I showed you, you could get approved with about 6 months in business and way less than 20,000 in deposits, probably 5 to 10. 6 months time in business. 2 max non-sufficient funds in a current month, 5 max non-sufficient funds in the last 2 months in order to get approved for this program. So love these loans. Again, the first one I showed you, we have a credit line for 100 grand with them. We started, got approved for, I think 3,000 or 6. Then they bumped us to 30,000. Then we used it and we went back and asked for a bump, and they bumped us from $30,000 to $100,000. And we use that credit line from time to time. You know, we'll tap in. For example, we just made we got a company's assets. They were basically not going under, but they were shifting into a different industry. We wanted all their assets. We were able to come in and buy all their trademarks, their assets, their domains, everything. And that wouldn't be normally, we wouldn't just usually take 12, 15 grand out of our pocket and do that. But it allowed us to just use the credit line to make that transaction and be able to pay a little bit in interest as we pay it back. And then we paid it back over a few months. We didn't pay much interest, and it worked really well. This is what revolving credit can do for a borrower. It's accessible when you need it. And that way, when an opportunity comes up, boom, you can jump on the opportunity and take advantage of it. We jump on a lot of opportunities using these credit lines to be able to do so, so very beneficial for borrowers. So another option is microloans, which you can't even get from a real bank. You can try the Association for Enterprise Opportunity to find a local microlender. We do a lot of these. We try to help our borrowers qualify for a lot of these and more. But again, you know, if you're looking to advise somebody on where they can find microloans, Association for Enterprise Opportunity, loans are typically up to about 35 grand with microloans, being the term micro, and SBA 7 or SBA 7M is microloans to 35 grand for working capital and growth, average about 10,000. So interesting product. SBA guarantees loans. They don't offer them, but this is an SBA product. This actually comes from SBA. Unlike most SBA products, it's not a 7A. A 7A SBA loan is for general working capital. A 7M is a micro loan, M, for working capital. Working capital just means they can use it for any reason. It's not like equipment financing that you have to use to buy equipment, or SBA 504 financing, which you have to use for equipment or real estate. With this kind of financing, you can use it for general purposes. The average loan amount's 10 grand, the high is 35. And again, the money comes directly from SBA with that program. So a micro loan, as I mentioned, is not a lot of money. However, it works really well. What we find on average when we survey a client is that startups only are looking for 10 to 15 grand on average. That's what we find. And we survey hundreds and hundreds and hundreds of clients, and we find that startups are only looking for about 10, 12 grand. So microloans are typically pretty small because a lot of the newer businesses that are out there, they don't need a lot of money. You're going to need some money here, which is why I put it under cash flow financing. But again, you're not going to need as much money to qualify for a lot of the other bigger loans that are out there. So peer-to-peer lending, according to Forbes, peer-to-peer lending is a new method of debt financing that allows people to borrow and lend money without a financial institution, harnessing technology and a big data, P2P platforms, peer-to-peer. You'll see P2P a lot. That's what it's short for. Connect borrowers to investors faster and cheaper than any bank. Biggest players include Prosper, Lending Club, Upstart, Funding Circle, Street Shares. Okay, and lenders have their own unique source. So here's how peer-to-peer lending works. And here's, again, a disruption to what we've seen that's really come up over the last, I don't know. I don't know. I think, I don't remember if it was Prosper Lending Club that got here first. I'm not sure. But I think it was Prosper, and then Lending Club. Prosper was here first. Lending Club accounts for 45% of the total overall peer-to-peer lending space. Upstart works with startups. Funding Circle or Street Shares works with veterans. Roughly, I'll tell you. There's more information on all this on our Facebook channel when we just went live on this topic. So here's how peer-to-peer lending works, and here's what it's doing. It's first of all much easier to qualify for loans because you're not qualifying with the bank. If you go to get an SBA loan, you're qualifying for the bank and SBA. If you go to get loans through an alternative lender, as most financing comes from, you have to meet their guidelines. And in a lot of cases, they may even be selling the paper to somebody else. In this case, you have individual investors. That some of them, like Upstart, you could get started by investing $100. Others, you have to invest $25,000 to even be considered an investor. So you have individual investors. So let's say I'm an individual investor and I say, look, the stock market sucks. It loses money. I don't want to put my money there. I don't get a big enough return. And I live in Florida. Real estate's outrageous because all these foreign investors come and buy all our property. So I want a place where I can get a really good rate of return on my money. I know higher risk means higher rate of return if it all works out, so I want to lend money. Well, then this is what peer-to-peer lending is. Peer-to-peer lending has opened up ways for a typical investor to invest money into businesses, into small business, which is a pretty freaking brilliant idea because the stock market, if you think about it, is all publicly traded companies you can invest in. Peer-to-peer lending is making it available for a typical investor to now invest in privately held companies. And so this is a really smart way for people to put their money in and invest. Then that money gets pooled into loans that then gets lent out to borrowers. And then again, they stand to earn really good rates of return, much higher rates of return than they probably ever earn in the stock market. So peer-to-peer lending has now gone to typical standard investors. Like I said, places like Upstart could invest as little as $100 and be in there. And then it opens up this whole world to regular people. So now all of a sudden regular people are pouring millions and billions, and I don't think we're at trillions yet, but we're pouring billions of dollars into a space that now all of a sudden this money becomes available for small business. Love the idea. It's fairly new, 5-10 years that we started to see this really become popular, and it makes it easier than ever for our borrowers to access cash, to access capital. So lenders have their own unique scores. All of them do. And from the ones I've looked at, which are the big players, they all look like their scores are gauging your risk of going 60 days late in the next 12 months. Now, to give you an idea, consumer and commercial credit scores look at your risk of going 90 days late. So they're looking at your risk of going 60 days late in the next 12 months is typically what their credit scores are looking at. Many factors determine approval. Consumer credit score, debt to income ratios, revenue and profits is what they're looking for. So again, this is why I put it under the cash flow financing. You don't need good credit to get it. Average credit, you can get it, but you should have, and that depends. Places like Lending Club may want you to have 650 plus score. So the scores are going to vary. But again, what they're really looking for is consistent revenue, a makes sense deal, and then their algorithms are taking into account these amongst many other factors. Fees range from 0.5% to 10%. Well, all the ones I saw really range from 0.5% to 5%. I put 10% because there may be other ones I haven't seen that charge higher, but I've actually really seen 0.5% to 5% fees. Terms range from 1 to 5 years, so 60 months, that's a long term. And loans are from 25 to 500,000. Typically, not all of them go to 500. Only 1 or 2 of the big players do. The rest of them are all like at lower than 300 grand, but you can get loans up to 500 grand in the space. So term loans, typically about an average credit score of 620 or so is required. The more score, the better the score, the easier these are to get. So term loans are just longer term loans. These are not SBA loans. they're kind of like alternative SBA loans. I oftentimes refer to them as alternative SBA loans. They're offered through individual or they're offered through alternative lenders, sometimes private investors. And this kind of financing, they'll let you in with average credit. You'd probably need compensating factors like good tax returns, etc. But the better credit you have, the better terms you're going to get, the better chance you have of getting approved. 1 year in business is required. As a matter of fact, most of these lenders are going to ask you for tax returns, which you won't have unless you're in business 1 year. You need to have $10,000 a month in revenue or more. Tax returns that show a profit or preferred. Look, if you're showing loss on your tax returns, you're not going to be able to get many of these term loans from alternative lenders. But if your borrowers are showing profits, even a little bit of profit, then that can really help them. Some lenders are lending equivalent to the profit, and then others really aren't. Their approval's not even based on the amount of profit you show. It really is looking at the revenue of the business, but they won't even approve you if you're showing a loss. So basically, good credit and financials are preferred for approval, but not required. Financials are typically required for approval. And again, good credit, not as much, especially if the financials look better. Some options are available without tax returns as well. Loans go up to 30 years, but in a lot of cases, they're still 5 years or less. Loan amounts in the millions. Again, these are alternative lenders. So this is in private investors. This is where a lot of your 10, 20, 30, 40, $50 million business money comes from. It's not coming from the banks. It's coming from these type of term loans. So small amounts to very large amounts, 8 to 15% rates are typical based on risk. And new sources lend from $500K to $15 million. Qualification based on the business merits, credit, cash flow, bank account management, tax returns. They're primarily looking at a make sense deal. So does the deal make sense? It's a good thing to look at. And really, if you really think about this, who is a lower risk loan? It's somebody that has not great credit, but they have a credit history that reflects that they pay their bills as agreed. They have good cash flow. They have more money coming in than going out. And that cash flow, that revenue, is increasing from month to month. And also in the cash flow, the profits are accumulating in the bank account. The money grows in the bank account month to month. Okay, good bank account management. There's more money going in than coming out. There's savings being accrued. The positive ending bank balance is increasing. The amount of deposits is increasing because the business is growing, and the amount of profits is increasing because the business is able to retain the profits. Tax returns that then show those profits, that reflect what's really going on in the business. If you think about this, this is a lower risk, more established business. And for these kind of term loans, this is really what the lenders are primarily looking for. Now, again, as I mentioned with 3 C's, cash flow, credit, collateral, in this case, we've got 2 of the C's. We're graduating. We graduated from an alternative lender that got us a cash advance to now an alternative SBA lender that got us a term loan. Longer loan term, lower rate, better for us because now we're accumulating C's. We got cash flow to get our first loan. Now we got credit helping us. So now we have 2 of the C's helping us, which get us into the better term loans. Then that gets us to the epitome of where we all want to be, SBA loans. The longest term, the lowest rates. This is when we now have all 3 C's, cash flow, credit, collateral, as we'll dive into. They're going to need 2 to 3 years worth of tax returns, personal and business, and it's typically 3 years. Here's what's interesting. They're telling you they need 3 years tax returns. That means you can't even apply if you're a startup. Startups can't apply because they don't have 3 years tax returns. So the reason for this is if you look at business failure statistics, the biggest drop in business failure, like it just drops like a rock the first 3 years, then it starts to taper off, meaning the longer a business is open, the less chance they have of failing. So a business the very first 3 years is extremely high risk. It's why SBA and conventional banks won't touch you. I say 2 years, but typically almost all the banks out there are now going to ask for 3 years tax returns. You might need profit and loss statements. You might need balance sheets. Remember, there are different kind of profit and loss statements. There's a current P&L. There's a projected profit and loss. So they might ask for different versions of this. Business and personal bank statements are going to be required as well. So they're looking at how you manage things personally and business. And they're going to want collateral to offset the debt. SBA loans are the only kind, one of the only kind of financing you'll ever find that will let you use a home as collateral for a business loan. Mostly business loans look at business assets as collateral, account receivables as an example. But SBA, their underwriting requirements, which is really interesting. I got to find this. One day I stood on a stage and found SBA's actual underwriting requirements, and they're pretty mean. They require the lender to take every asset as collateral that the business has, and if those assets don't exceed or meet the loan amount, then they force the lender to go after all of your personal assets. So what they're looking for here is they want your assets, the collateral, to equal the loan amount. And they will take your house as collateral if need be to make that happen. One of the only type of loan programs you're going to typically see that. So you're going to need collateral. Positive financials that show growth, increasing net profits on tax returns. Lenders want to see use of funds. So they've got to make sure they want to know what you're using the money for, make sure it makes sense that the business is going to be able to afford the payments, of course. Good credit is required, meaning that they will tell you, SBA will tell you, that you need a 620 plus FICO score. But if you look at SBA's loan checklist, they will tell you, quote unquote, to fix any or to, I don't know the word they use, but they say to address any quote unquote blemishes on your credit report. To me, a blemish does not mean your credit is wrecked. It means even a minor thing should be fixed. So even though SBA says 620, I completely think it's bogus. We've seen 780 FICO score borrowers get denied because of one late payment on a major bank account like Bank of America. So, or on a major credit card backed by a major bank like Bank of America. So I don't go with the 620. I used to own a consumer credit company. I know what 620 borrowers look like. 620 borrowers would not get an SBA loan. So even though they say 620, realistically, you need a 700 type borrower. You need somebody with, as SBA says, no blemishes on their credit report. But it doesn't stop there. You also have to have good established business credit. The reason for this is that SBA loans now require an SBSS score. That's a FICO small business score. Your FICO small business score must be 140 or higher to get approved. Many banks won't even do it less than 150 because SBA's bare minimum is 140. So most banks underwrite higher than SBA's bare minimum. You cannot, it is impossible to get an SBSS score that high unless you have business credit. The way FICO SBSS works, they go to pull your business credit report data first, then they pull your consumer report data and populate it into one score. So the problem is that if you don't have business credit established, you cannot. It is impossible to have an SBSS score high enough to qualify for an SBA loan. So you have to get business credit established at this point. And you also need the third type of credit, which rarely is talked about, which is called bank credit. And bank credit is only your credit rating in the banking system from the big banks like Bank of America, Chase. You'll never see the score. You'll never know what it is. But whenever you go to get a credit card, credit line, or loan from your bank, you better know it's being used. And I've got plenty of training on this on our YouTube channel. But I will tell you as simply put as possible, to get a low 5 rating, which is the bare minimum to qualify, you must have $10,000 on average in your bank account over a 90-day period. And for the record, they want it to be 70,000 or higher. So 10,000 is the bare minimum. So you've got to have good consumer, good business, and good bank account or good bank credit to even get considered for an SBA loan. This is why so few of your borrowers will ever qualify. These are typically very well-established businesses before they get to this point. SBA credit lines from SBA. CAP lines is the umbrella program under which SBA helps business owners meet short-term and cyclical working capital needs. Loan amounts available up to $5 million. Loan requirements the same as we'll talk about here with other SBA. They have multiple of these. A seasonal line, which is just what it sounds like, and it's a credit line that works for seasonal businesses. A contract line, which is just what it sounds like. It works with financing of direct labor and material costs, typically associated with construction projects. You have a builder's line, which is very similar. The reason this kind of financing is very standard for construction is because you have a lot of workers out there installing plumbing, for example, that don't get paid for months down the road until the home is completed, sold, etc. So as a result of that, many of the direct labor people that are doing the labor building the homes don't get paid for a while, which is why this kind of financing exists to float those people till they get paid. Standard asset-based credit line for businesses unable to meet credit standards associated with long-term credit. So this is financing for cyclical growth. And the small asset-based line, which is exactly the same thing, just dealing with smaller amounts. So what's interesting about SBA's credit lines is almost all of the ones they promote, all the main ones they promote are for specific purposes or industries like seasonal businesses, construction, etc. Venture capital. So according to Investopedia, venture capitalist is an investor who either provides capital to startup ventures or supports small companies that wish to expand but do not have access to equities markets. Venture capitalists are willing to invest in such companies because they can earn a massive return on their investment if these companies are successful. Let's talk about this for a second. This is the difference between lenders and individual investors. Lenders really care about risk, and the bigger the lender you get, places like Bank of America and Chase, they are so conservative with the risk, they won't even touch middle risk stuff. They want low risk. Investors are different. Investors, whether it be peer-to-peer lending or these kind of investors, they want high risk. You heard it right. They want high risk because high risk equals high returns. They want to invest in riskier stuff because they want to make a large bang for their buck. And the only way they could do it is to put money into the higher risk stuff. They know that a portion of it won't perform. They know it. They expect it. But they're hoping for the stuff that does perform be a home run that makes them more money than they'll ever know what to do with, right? So if we look at the guys that are here that are, Jeff and Jeff Bezos and all these guys that run these big companies like Elon Musk, these guys exited from companies. They got a ton of money and they invested into other businesses. And think about the people that invested into Uber and Airbnb. These people are billionaires. So again, not all of them, but some of them. So again, what they're looking for is high risk, high return. So there's two ways you're going to find this. There's individual investors and there are funds. Now, funds pull together money from investors. A venture capital firm itself, wealthy people, pension funds, foundations, insurance carriers, corporate pension funds. So again, a fund will pull together a lot of people's money like peer-to-peer lending does, while an individual investor will invest their own money. So I don't know why I have this on here twice because apparently it was that good. These guys invest into different rounds of funding. You've heard before. Seed funding, earliest round of financing, needed to prove a new idea. Okay. Now this usually comes from angel investors. And here's what I want to talk to you about. There's a difference between angel investors and venture capitalists. Angel investors typically invest in startups. The amount they invest is very, very small. It could be hundreds to even 5,000, 50,000 typically max. And they don't want a big ownership stake in the business. They don't want to be on your board of directors. It's a smaller way to get money to start a business. As you get through this seed round, then you start to get to a point where you start to get established. And the further you start to get through these rounds of funding, the more venture capitalists come into play, as you'll see. So startup, early stage firms which need funding for their expenses from marketing and product development. They're building a product. Growth, Series A. Early sales and manufacturing funds. This is typically where VCs enter the picture. So seed funding and startup is usually angels. Then when you move to growth Series A, this is typically where VC comes in, okay? And this is the first institutional round. Here's where most companies will have the most growth. So think of it like this. Seed and startup. Seed, you got an idea. Startup, you're starting to build it. You're starting to think about marketing. You start to think about expenses, etc. Series A, you now actually have a product. You might not be profitable, but usually you're starting to make sales here. Not even that you have a profit, but you're starting to make sales. So once you start to make sales, venture capitalists start to come into the picture. Second round, working capital for early stage companies which are selling product but not yet turning a profit. Expansion, mezzanine financing, expansion money for a newly profitable business. Bridge financing, a startup seeks funding between full venture capital rounds, between these rounds, okay? And VCs usually leave via a secondary sale, IPO, or acquisition. So venture capitalists are only going to come into play if you have a really good idea that could be an absolute home run and you got a plan to exit in about 3 years, maybe 5. These guys want to make their money back in about 3 years. So again, you're not usually starting up at this point. You're usually been in business maybe 1 or 2 years, getting by with angel funds. Now you're starting to make sales. From that point, they're going to want about 3 to 5 years to exit. So you're going to have a good exit plan. You're going to have to prove that it's working and that you're making sales. But again, this is a kind of financing that's available based on revenue. You're not, remember, I didn't put angel investing here because angel investing, you don't need the revenue. You can get it even as a startup. But venture capitalists, you're going to have to start generating revenue here, even though they're not looking for profit. And of course, you're going to give up a percentage of the business in return. And that's what you have to look at. How much of the business are you going and willing to give up of ownership to get the money? Would you rather borrow money and pay interest on it, or get money from these kind of investors, not pay interest on it, but give up partial ownership of your business? That's what you got to decide. Okay, but venture capitalists do have a place in it. So cash flow, credit, collateral.